LMND just reported their latest earnings report, and it was yet another beat across the board. At the time of making this video, the stock is up around 8% or so, has a market cap of just over $1.2 billion. EV to sales in the next 12 months will be about 2 times. So definitely not that expensive. Of course, still not profitable. But on that front, we do have some positive news. Now, with regards to what the analysts are expecting or were expecting, plus the next 2 fiscal years, you can see the top line growth is expected to be 28 and 23% year over year for fiscal year 25 and 26. For fiscal year 2024, that's around 18.79%. But of course, with insurance, you're not just looking at revenue, you're looking at in-force premiums, gross earned premiums, stuff like that, loss ratios. There's lots of important metrics to follow. And of course, more specifically with regards to Lemonade, it's the profitability side of things, it's the cash flow side of things. And on that, we do have some positive news. More on that in just a second. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Well on our way to reach 40,000 subscribers. So thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, in-force premium for the quarter increased 22% year over year to $794 million. Premium per customer increased 8% to $379. Total customers increased 13% year over year to now 2,095,275. Gross loss ratio, yet again under 80%, an improvement of 8% year over year. Gross earned premium sits at $188 million. And as you can see, losses are improving. Now, as always, they do talk a little bit about tech, about AI, how this company was already built from the start on the premise that technology, AI, the use of that is just going to make the insurance industry much better. And that's why they've built their company on top of that tech stack, unlike plenty of other insurance companies who have built their companies on top of pen and paper and are now trying to change everything and migrate to tech. So they're already seeing some huge benefits from that. One example they give us here is the loss adjustment expense ratio, which is defined as loss adjustment expenses divided by gross earned premium, measures the operational overhead of managing claims. And since it's generally unaffected by growth spend and underwriting results, it is an excellent measure of operational efficiency, and so is a particularly helpful way to benchmark Lemonade's efficiency to the industry. So they give us even more examples here. A loss adjustment expense ratio of around 10% is typical of leading insurers with tens of billions in premium. Now, despite Lemonade's relative small size, their ratio sits at 7.6% in Q1, so notably better than the benchmark, showcasing how technology can dramatically drive efficiency even before the benefits of scale kicks in. Indeed, they have nearly halved this ratio in just 2 years, as you can see right here. Now, of course, as they scale, as they enter new markets, etc., yes, sometimes the numbers can be a bit bumpy, but overall, for a small company, this is already quite impressive. The more dollars that will flow in my opinion, the better it will be in the long run. Now, they do give us an example here with regards to their pet business. In the past 2 years, in line with the rapid growth of the book, they saw a near doubling of the number of claims submitted, but a less than 15% increase in claim support team headcount. The chart shows how their post per claim has declined by nearly 60% since Q4 of 2021. This playbook, the relentless pursuit of automation at every stage, enabled by a range of AIs, is actively being applied in all of our lines of business and all parts of the company. Case in point, our headcount shrank 11% year over year, even as our total book surged by 22%. This speaks volumes for the widespread impact of technology throughout the company. And so, the big news here is with regards to cash flow. So they now tell us this. So previously they indicated their expectations that net cash flow break-even would occur during the first half of 2025. Now, thanks to sustained strength in the underlying unit economics, impact of technology in the various expense categories, and working capital benefits of their insurance structure, they now expect to get to that date at the end of 2024, such that by Q1 2025, they expect to be generating positive net cash flow on a consistent basis. Net cash flow break-even, while an important milestone, is certainly not their final destination. They are increasingly focused on what comes next. Once generating positive cash flow, they expect to benefit from increasing cash and investment balance with growing investment income contribution. This will enable them to lean in and reinvest in cash flow generative, capital light growth with maximum confidence. I think that when this gets announced, and by the way, the fact that they're announcing this already right now means that they're pretty comfortable announcing this, which means the probability of them not making it is quite small. And so moving on to the last couple of numbers here, then we're going to look at the guidance. So ADR, annual dollar retention, was 88%, a 1 percentage points improvement year over year. Cash, cash equivalents, and investment totaled approximately $927 million. As of March 31st, 2024, approximately $186 million is carried by our insurance subsidiaries as regulatory surplus. And so overall, as you can see, things are improving top and bottom line. So, as for the second quarter, they expect in-force premium between $839 to $841 million, approximately 22% year-over-year growth. Gross earned premium around 21% year-over-year growth. Revenue growing around 15% year-over-year. Adjusted EBITDA loss, an improvement of 11% year-over-year. That's for the second quarter. As for the full year, what is highlighted here means that they slightly raised or beat the estimates. So in-force premium for the full year expected to grow 26% year-over-year. Gross earned premium around 22% year-over-year. Revenue around 20%, so a bit higher than what we saw at the start of this video. And adjusted EBITDA loss, a 13% improvement year-over-year. And so right now, looking at the stock, it's up around 7 to 8%. Can obviously fluctuate throughout the day, plus Jerome Powell is expected to speak, so that might impact the stock market as a whole. Right now, $18.54. We've been there before. I mean, we've been around the same range or so since October of 2023. We are above the 20, the 50, and the 200-day moving average. So I do think that the stock is in a good place right now. The business is in a good place as well. So probably it's a pretty good setup for long-term investors. So overall, to conclude, nothing more to add. Another solid quarter by Lemonade. Yes, I know most of us might still be in the red, myself included. But what I like to see is the business improving. The business is moving towards profitability faster than expected. Eventually, the stock will react accordingly. So what can we ask more? Of course, that's just my opinion. Of course, do share yours down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.